Welcome to the Craftsman Founder Podcast, hosted by Lucas Carlson. Every week, we talk to founders, entrepreneurs, and those who've made a craft out of creating companies and enterprises. Listen every week to get ideas for starting, promoting, and growing your business. There are no shortcuts, just good old-fashioned hard work and craft. So sit back, relax, and enjoy this week's interview.
Hello, this is Lucas Carlson from the Craftsman Founder Podcast.
And this is Elliot Pepper.
And this week we've got a great guest coming up. So Tim Porter was one of my investors. He invested in AppFog. He helped guide me. He was the first venture capitalist to believe in me. I had raised some seed funding before him, but he was the first real true venture capitalist to go all in on me. And interviewing him was a lot of fun. It was really great to help other people understand, because when I started creating AppFog and thinking about startups, I didn't really understand venture capitalism. I understood you get a big check for millions of dollars. I didn't understand the people behind those millions of dollars. And during the process, I got to know Tim, I got to know Frank, who's also been on this podcast. And I wanted to share that with people who might not have had that experience. And so this is a great way to do that and to give back and to help other people understand that it's not just check writers, they're not just money bags, these are people, they have families, they have cares, they have concerns. And so really excited to talk to Tim, and Elliot joined me. Elliot, what did you think of this conversation?
Oh, I loved it. I mean, I think that, it's really important. What's interesting is when you're going out to raise your first round of financing from venture capital, it is very tempting, as you said, to think about it as a money bag or a checkbook, right? Because you're thinking about what you need for your business. And I think it was really instructive to talk to Tim, because he did such a good job laying out how VCs and other venture investors really think about the kind of work that they do. And if you don't understand where they're coming from, you have no hope of accessing the checkbook that you're looking to do in the first place. And I've worked on both sides of the table, both on the investment side and on the fundraising side during numerous early stage financing. So I thought talking to Tim was just wonderful, because he did such a good job laying out the roadmap.
Awesome. So in one of the earlier episodes, we started talking about a book that was just about to come out by Tony Robbins, Money, Master the Game, and it has come out since we've talked, and so now it's out, and now I've been able to read it, and it's been really interesting, so I just wanted to share kind of an update on that, because we've talked about kind of anti-fragility on the podcast, and the anti-fragile investment strategy of having 80 or 90% in very safe things like tips or even like money market, very, very safe things, and then putting 10 or 20% in very, very high risk profile. And the idea,
barbell.
Yep, the barbell. And the concept is that way you are capped. Your risk is capped at the you can't lose more than 10 or 20% of your entire portfolio, versus something like modern portfolio theory that diversifies the assets in bonds and stocks and different kinds of things. And so it was really interesting, because I've been looking forward to Tony Robbins' book coming out, and so I got to finally read it rather than just hearing the podcast interviews, and I looked into the diversified assets and the kinds of assets that Tony Robbins had interviewed some of the top money managers in the world and hedge fund managers, and their recommendations were in the book. So it was really interesting, because understanding not just what those recommendations were, but also why they were thinking, like the all-season investment strategy is basically to have kind of a quarter of your assets, 4 quarters divided into different things that are supposed to go in different directions, so that when the stock market's doing great, your stocks go up, but when they're doing bad, the other parts of your portfolio will make up for it. So that's kind of the idea of the all seasons, is there are 4 seasons of any market, and if you can cover all 4 seasons in a diversified portfolio with different asset classes, then you'll do well in all of them, and you won't go crashing. With if there's one of them is crashing, the other 3 are tending not to crash. And so what was interesting is to understand not just that concept, but why they recommended kind of the approaches and the asset distribution. And so definitely pick up the book if you want details. And I can't remember them off the top of my head, so I'm not going to give them exactly. But
so I have a question. I have a question. So if the barbell theory is keep most of my money safe and make a few big bets, right? Like on highly risky stuff that could have a nice outcome. How did reading this book change your perspective on that strategy?
Absolutely, that's a great question, because reading this book, I realized there's actually psychology behind this all seasons diversified asset class investment strategy, and it's the psychology of it is that the net return is not going to be higher than the net return of the stock market. So if you put all of your money in stocks, you're actually probably going to, in the long run, have a better outcome. The idea of doing these kinds of investments with diversified asset classes, it's not to maximize your return. It's actually to manage your own psychology. So the idea, the concept was that you want to make it so that you don't lose money, because when you lose money, your natural kind of instinct is to pull out, and that's the wrong way to do it. So if you're losing money and you pull out, and then you're going to miss out when the stock rebounds. And so the whole idea of the all seasons is to manage your own psychology, not maximize your gains. And so when I understood that that's the psychology of the all seasons, is to minimize losses and maximize gains within minimizing the losses, I realized that there's actually the all seasons multiple asset approach is actually quite similar in many ways to a barbell portfolio, because they're both trying to minimize your downside. In the all seasons, the downside in any given year, I think the maximum downside was 2 or 3 or 4%, somewhere like that, and the upside was something like 6 or 8%, maybe 10%. I don't think it was that high, but so the idea was to try to minimize your losses in any given year so that you don't pull out your assets and they can keep reinvesting and they can keep growing. But that's also it's interesting because it's actually the barbell theory is also very similar in that psychology. In the psychology, you can't lose more than 10 or 20%. Whatever you are willing to lose, you can't lose more than that. And so it caps your downside risk. So they actually had a lot in common. One of the things.
And when the rubber meets the road, are you investing on a barbell strategy or on a 4 seasons approach or on something else entirely?
Yeah, well, I've been like thinking about blending them and having the 4 seasons be the 80% and then using a barbell and doing 20% in highly risky stuff. And trying to have kind of the best of both worlds. But 2 things prevented me from I was just thinking about doing that, and I was like, it didn't actually appeal to me because 2 reasons. One is that it makes it that much more complicated, and it gives you that much extra work to do to manage stuff, and it's like I don't need another job in my life. The second thing was if a simpler way than the all seasons to do kind of an 80% and manage your downside risk would be to invest the 80% in the stock market. And again, I'm not a financial advisor, so don't follow my advice. It's just ideas that I've read about. Is to invest it in the stock market, in the SPY index, and then protect yourself by buying puts, stock options for the SPY index, which prevent you from losing a certain amount. So you can buy puts so that if the stock on the index drops more than 10%, you can always sell it for the 10%. So if the stock market crashes to 50%, you can always sell it and only lose 10%, and you've protected your downside risk. And it costs something like 2 to 3 to 4% per year. So if the stock market goes up 10%, you've only made 6%. And so it's almost a similar outcome. It's just a simpler way to manage your downside risk than doing an all seasons, which requires you to have more places that you have your money. But even that was like a little bit more complexity than I was thinking. So like right now, I think that I've been one of the reasons that I'm going more with a barbell approach at this point, where I've got the highly risky. I invest in startups and stuff that's speculative, only the money that I can lose, and the rest is being put in really safe places. And one of the reasons I chose that was I personally have a lot of uncertainty about the stock market and the bond market. I don't know what's going to happen when the Fed starts raising the rates, and I'm not nearly smart enough to figure that out. But like instead of I don't know what might happen. Like at this point, I'm at an age that I'm kind of young enough that I can wait till there's another crash. And when there's another crash, if I have 80% of investable money just sitting on the sidelines, that's when I can go in on the stock market and I could shift strategy. I could shift from a barbell strategy into something when the market is crashed and everybody's scared. And so that feels right to me. I don't know what the future holds, but it's been 5 years of a bull market, and that's a very long time to have a bull market. And so it
time to start buying gold.
It seems like it definitely seems to me like it's time for a market correction, and I'm not good enough to know when that's going to happen. So it's it feels a lot more comfortable to have a lot of the investments in very, very safe things right now. But again, don't take my advice. It's just thinking off the top of my head.
So maybe bringing this back to Tim, I think what's really interesting is that Money, the book that we're describing, and Anti-Fragile, they have a lot to talk about on the stock market side and the public market side, in addition to everything else, right? But when we get down into the weeds of venture capital investment, it's a different world. And it's a different world in part because it's much more opaque, right? When you're investing in a public company, they have reporting requirements. You have analysts that are doing. There's a lot of public information. There's a lot of regulatory oversight. There's a lot of analysis that goes on an institutional level. But when you're looking at private companies, and not just private companies, but newly formed private companies, it's a really different world, and that informs the psychology of how VCs make their own investments. And I think that was part of what made this conversation with Tim so interesting, is that he was very forthright and sort of straightforward about how he looks at the world, right? And about how when VCs are vetting startups to write checks to, they have specific things they look for, like he mentioned sort of, relentless creativity, I think was one of the aspects he looks for. And also some sort of simple things that we'll let him dive obviously way more in depth on, but just that VC partners, unlike a trader on Wall Street who might make hundreds of bets a day, right? And if you're in a high-frequency trading house or a hedge fund, you'll have computers that are making thousands and tens of thousands of bets every second, right? And the VC side is almost as far from that as you could imagine while still being an institutional investment, because VC funds are 10 years long, so they're investing on a long time horizon, and they're only making a couple bets a year, which Tim will talk a lot more about. But you can imagine that if that's the kind of investing you're doing, it's a very different mindset that you have to bring to the table.
Yeah, one of the other parts that I'm very excited about this interview for is that Tim's background is a little bit unique for people that have been on this show, because Tim, before being a venture capitalist, his job was doing mergers and acquisitions for Microsoft. So not only did he do M&A, but he did it for one of the biggest companies, software companies in the world. And we ask him about that, and we ask, why do big companies buy small companies? These are kinds of questions that, as much as founders don't know about VC, they even know less about M&A. And so digging into this from somebody who did M&A was one of my favorite parts of this interview.
I really loved that. I actually literally just got off the phone with an entrepreneur based up in Canada, and he was approached by an acquirer in this summer and went through this whole process. He had never raised venture investment or gone through an M&A process before. And 2 days ago, the deal fell through. They were like right up to the end, and 2 days ago, the deal fell through. And we were talking about exactly this point, that understanding, again, the psychology and the mindset that large companies bring to the table, and the strategic reasons that they actually choose to buy smaller companies and new technologies is critical for entrepreneurs to understand. And it is, as you said, there's sort of this corollary where new founders don't really know how VCs think, even though they need them, right? Or they might need them for their business. And then once they've figured that out and rope in the VCs and hopefully achieve success, suddenly there's this whole new hurdle of how do acquirers think, and how does that work, and what's the strategy there? What I love about Tim is I think he's going to help listeners really sort of short circuit some of that learning process, because he obviously has a tremendous amount of experience and has done so many deals in this space that him sort of just sharing his thoughts is super valuable.
Yeah. Well, let's let the listeners get into it, and this has been fun, and we'll start the interview. Tim is not just a guest. Like many of the people that have been on this show, Tim is a great friend of mine. He's really interesting because he is a professional venture capitalist. His background is super fascinating because before becoming a venture capitalist, he actually did mergers and acquisitions for Microsoft. So this guy is super smart, but it's more personal for me because if you've been watching this show, you might know that when I started my company, I actually quit my job a few months before my son was born. So I had no children, and my wife was 6 months pregnant. I went up to her, and I said, I'd like to quit my job and start a company. And I don't know how she ever said yes to this, but she did. And I decided, okay, I'm going to raise venture capital, and I spend months and months and months. I talked to dozens of venture capitalists. I talked to angel investors, and they all think it's interesting, but none of them seem to have the courage to say, I believe in you, Lucas, and I think this is the right idea, and let's do this. Tim Porter was the first venture capitalist to write me that big first check. We had a little bit of angel investment before he came in, but this guy was the first guy to sit down and believe in me. For that, I'm eternally grateful. and I'd love to pick his brain. So Tim, thanks for joining. And like last week, we've got Elliot Pepper as our co-host. So welcome, Elliot, as well.
Thank you.
Thanks, Lucas. That was a really nice intro. It was an easy and fun bet to make, and it was great to work with you for those years. You know, those other guys you pitched, they either knew something I didn't, or I knew something they didn't, or something of both. But it worked out really well. So it's great, and it's great to be with you today.
Well, thank you. So Tim, can you tell people about your background?
Yeah, I'll just add a little bit from what you said. So I've been at Madrona for just over 8 years now, and focus on investing in enterprise and B2B software, so lots of things in cloud computing and infrastructure and analytics, etc. You know, AppFog and PHP Fog is one of the original PaaSes, definitely fit, you know, closely into the types of things that we love to invest in here. As you mentioned before that, I was at Microsoft for 3 years in M&A. I worked with, you know, predominantly the server and tools division there, so kind of continuing the theme of sort of B2B software and infrastructure. And then earlier in my career, I worked almost 5 years at a startup. So I was one of the early employees at a company here in the Seattle area called Teledesic. That was a broadband satellite company that ultimately wasn't highly successful, but learned a ton about, you know, working at startups and being an entrepreneur, and lots of lessons that I've carried with ever since.
Awesome. So tell us about Madrona. Madrona's
Yeah, Madrona Venture Group. We're a kind of a classic venture capital firm that invests in early stage technology companies, predominantly in the Pacific Northwest. And so we've been around for about 20 years now. We invest in, you know, kind of broadly speaking, software, mobile, and, you know, internet companies, both enterprise and consumer. We've got about $1 billion under management. We'll do Series A investments and invest, you know, between $2 and $5 million, and we'll also do seed investments where we'll invest less than $1 million. And our model is to try to, you know, really, you know, partner closely with the entrepreneurs we back, become part of the team, and help them to grow their business. One of the first investments that Madrona made was Amazon. And we've always had this strong sort of association with the Pacific Northwest, you know, Oregon, Portland, where you are, Seattle, and Vancouver, BC, and we're not limited to investing in the Northwest, but we're passionate about building the ecosystem here, and it's been really exciting to see how drastically it's grown, you know, even in the 8 years, you know, since I've been doing this. So it's a fun time to be a VC or to be an entrepreneur in the Northwest.
Awesome.
And actually, if I could jump in with a quick question, you know, the fact that you actually do seed and Series A focus with Madrona is somewhat unique. A lot of the larger funds focus on later stage investing, and those early stage bets are actually where there's been a lot of change in the VC world in the past few years. Can you comment on that? Is there anything special that Madrona has seen or that you guys have learned over the course of those changes?
Yeah, thanks for asking. You know, our strategy has always been consistent in the 20 years, is that we think that the strongest returns come from investing very early, and early can mean, you know, seed or Series A. And our approach for seed is not one where, you know, let's say we'll invest in 25 companies and then sort of, you know, not pay too much attention, and then, you know, a year and a half later see which 5 are doing the best and try to double down on those. The model is for each seed investment that we do, we try to be very careful about what milestones do we want to, you know, work together to hit over the next, you know, 9 to 18 months. And assuming you hit those, we want to invest in the next round. So we invest in a really high percentage of follow-on rounds in our seed deals. It's sort of a, you know, we have this philosophy of, you know, don't overcapitalize companies and every dollar matters, and so it's consistent with that. Let's put in just what we need to sort of collectively say, yep, let's go take the next step, and then let's work hard to be able to do that together.
One of the things I've talked about before, I'd like people to understand what it's like to be a venture capitalist, to kind of get a better sense of why you make the decisions you do. Can you tell us how many times a week do you get pitched on, you know, general order of magnitude?
Yeah, what's a kind of a week in the life like a little bit?
Yeah.
You know, so Mondays were generally spent largely internally, kind of working with other partners here at Madrona, talking about all the companies that pitched us and we're working on the week before, where we are in due diligence on different companies, and trying to prioritize, which new investments we're going to spend time on, and then making investment decisions, and also talking about things that are going well or aren't going well in the existing portfolio companies. Then the rest of the week is split between working with the companies that I'm on the board of or working with and looking at new companies. And that really depends. There can be some weeks where 80% of the time is working on existing companies, and there's other weeks where 80% of the time I'm spending looking at new companies. And some weeks, at minimum, I'm sort of getting pitched by, at least, 3 to 5 new deals every week. Sometimes it could be more than that. Probably a heavy week would be, 6 to 8 or something like that. And this doesn't include all the entrepreneurs that we're fortunate enough to interact with in email and other things that would lead up to a pitch. And then you funnel down within those, and you spend a whole bunch of time kind of getting to know the ones that you ultimately invest in. And then again, because our model is very much we want to partner with the entrepreneur to really help them across recruiting and strategy and other things besides product, things beyond just sort of where's my next round going to come from, then you do end up spending a lot of time working with your investments. You generally will make a new investment decision in a month, and then you spend 6 to 10 years working with them. So the biggest part of the engagement comes after you invest, not before.
And so that's if you're doing 5 to 10 pitches a week, there's 52 weeks in a year. That's hundreds of pitches. How many investments do you personally commit to in a general year?
It would typically be 1 to 2 per year, and probably the average would end up over time being closer to 1 than to 2. So, to your point, you end up only being able to invest in a very small percentage of the companies that you meet. Which is often the hardest part of the job, right? I love this job because you get to be inspired by all of these really smart, passionate entrepreneurs who generally have good ideas, right? I mean, not every idea is a good idea, but there are a lot of ideas that are very plausible, and kind of being able to figure out which are the ones that you're going to actually invest in and be able to work on are super important decisions that last for years.
Does that one investment a year include your seed deals?
Yes and no. We tend to spend as much time on a seed deal in many cases as we would, quote, a full venture deal. So yes and no. There could be a situation where you do a seed deal that's a little bit smaller and they're with some other folks, and that maybe would say, all right, I'm also going to do another kind of larger deal, or not.
What do you think entrepreneurs' biggest misconceptions about raising money are?
Yeah, that's a great question, and it's probably, it's different for different entrepreneurs, but if I had to generalize, I would probably say that they're trying to sort of tell the investor what they think the investor wants to hear, right? Instead of being authentic and really just talking about why this is a good business and why they think and what they want to do with that business and why they can be successful at that business. And some of the specific examples within those, kind of telling me what they want to hear is, could be, how fast they think, need to say it's going to grow, even if kind of when you dig into it, that's not actually how fast they think it can grow, or that they either think you want to hear that, this is going to get acquired very quickly, and we'll talk about that maybe a little bit more, or maybe that they think you want to hear that this is going to be an IPO, in some certain period of time. So I think that the general thing is sort of like, be authentic and honest about your business, and also, just because something might not be a good fit for venture capitalists doesn't mean it's not a good pursuit of time either, right? So there's all different kinds of businesses, and some are great bootstrap businesses, and some are great businesses that just need a little capital from friends, family, and angels, and there's other businesses that you need and should have venture funding, and some are different phases along the way to do that. So I think be honest about your business and really talk about it the way you believe that it is. And you need to have a good narrative for how that all fits together, and hit on the things around why there's a pain point and why you solve it, and how much you can charge for it, why there's a business model, and how big you think it can get, and how you can defend against competitors. So it's not to say there's not things you should think through in sort of a structured way, but tell the story in a narrative that is meaningful to you and specific to your business, as opposed to what you think there's some formula that the VC is expecting to hear.
And to take that to the next level, if there was one message you could give to entrepreneurs before they pitch you, what would that be?
For me, it's always about, customer centricity, and really knowing, thinking about, and understanding your customer. And when you think you've kind of done enough work in, customer development, as it's typically referred to, go do more. And so it's one that it seems like an obvious, thing to say. Is like, well, of course, I need to kind of know my customer, and that takes on different forms. If your customer is a consumer, you're trying to provide a product that's going to entertain them, it's a very different, customer development is a different exercise than if you're going to sell something into IT at an enterprise to save them time and increase productivity. But in all cases, kind of making sure you really understand the customer, and that's one of the things we look for, among the various attributes, is someone who is really passionate about their customers and solving a pain point.
Makes a lot of sense. I think that acquisition is a goal for a lot of many first-time entrepreneurs. They think that maybe startups can be an easy way to make a lot of money by getting acquired really quickly. How do big companies actually evaluate startups? You've been on the other side of the table. Is that how big companies think about it? What does a big company care about in terms of acquisition?
Yeah, good question. Well, I'm going to back up and even say first that acquisition should not be a goal. If you're an entrepreneur, and if your goal is to build something that's going to get acquired quickly, you're probably doing the wrong thing. And I think whether your audience is an investor or it's an acquirer at some point down the road, or it's just yourself in the cold dark of night, the best businesses ultimately are bought; they're not sold. And the best businesses are ones that you create to be long-term standalone businesses that can be self-sufficient and profitable, not ones that are built to be acquired. And if you build your business to solve a problem that's a problem that can self-sustain itself and be a standalone business, guess what? You're probably going to have opportunities along the way where people are going to come along and say that they want to buy you. And it's a much better opportunity to be able to say no, or maybe you say yes. Maybe that's the right thing at the right time for you as the founder and for all of your other constituents. But when you're building it to sell it, it generally doesn't work well. I think investors suss that out, and I think acquirers suss that out. And so, it doesn't mean don't be strategic. You should be strategic about your ecosystem. Who are your competitors? Who are your partners? Who might be the acquirers? What decisions can I make today about product, technology choices, go-to-market choices that might align me best with people that would someday be interesting acquirers? Those are all important things to think through. And if you don't, you can make some mistakes that will sort of box you in, down the road. But that's different than saying, I'm building this to flip it or to be acquired. So then, to answer your question from the acquirer standpoint, I think what acquirers are really looking for, I'd say there's kind of three different things that acquirers are buying. You're either buying, team, or you're buying, product technology, or you're buying, customers and revenue. And I wouldn't say this is sort of in an official process at Microsoft, but we always sort of ask ourselves that question. And I think all acquirers do. Which one of those things are we doing? Or are we doing all of those or some of those? And then that sort of helps to assess it. If you're essentially just buying a team, then how good are these people? Do we think they're going to stick around? What motivates them? What are their strengths? What do we need, inside the company? If you're buying product and technology, how does it fit into our roadmap? How does the technology mesh? Is this checking a box, or is it a new business? And if you're buying, customers and revenue, how does it fit into your sales channels, etc.? And I think in all cases, acquirers try to think of it then in terms of, well, could we build this, or do we buy it? What are our options? And try to boil that down into some sort of, ROI, NPV kind of cash basis for why they should, potentially acquire somebody versus one of those other options.
And for when we are sort of taking this day in the life of an acquirer, you talked about how an acquirer might assess a potential company for acquisition. But what's the emotional undertone? What actually drives the decision to buy one over the other? And an example on the VC side might be like, Chris Sacca from Lowercase Capital is famous for talking a lot about fear of missing out being a big emotional driver for earlier stage investors. What's the equivalent for an acquirer? Why would you, if you have 3 companies you're looking at that do check those boxes, what drives you to make that buy decision?
Yeah. I think there's different situations, right? The fear of missing out is definitely very real, especially if it's a competitive situation, right? And if for some reason there's multiple companies, maybe they're competitors, and they're all looking at potentially acquiring this. There's a big driver around that. I think all acquiring companies though try to say don't let that be a driver. And then ultimately it probably is, at some point. You don't want to make decisions just to be defensive and do it so somebody else, doesn't do it. That being said, I would say in acquisitions, like, relationships matter a lot. And so, things that lead to companies wanting to buy other companies are they already see the earlier stage company in accounts with customers, right? So you're there. You're winning business, you're delighting the customer, maybe you beat them, and they're trying to sell something, and hey, wait, who is this other company that we constantly see in accounts, and why are they doing really well? Maybe you're already partnering with them. Maybe it's some sort of joint go-to-market. There's some way you're partnering, and they get to know you. And so the relationship is both from kind of seeing how your product and team works and sort of delights customers, but it's also realizing these are people that you trust, that you're going to work with. It's often, a GM, a VP, a president, a CEO at acquiring companies saying, hey, this is a team, maybe this is a CEO, this is a management team who I want to put in place, to be important kind of parts of my team and deliver. All of those things end up, it's not the only thing, but they tend to matter a lot. And if you don't have that, if it's just sort of a cold start, like, hey, we think that XY might acquire us, and like you've never talked to them or never had a relationship with them or any of those things I just talked about, guess what? It happens, but it's pretty rare that leads to an acquisition.
So that's a fantastic point. So let's say out of any 10 given acquisitions that you might do, how many of those do you already know that company and have a relationship, or has the companies worked together in some form in the past?
I would say 9 out of 10.
Yeah,
it could be varying degrees, right, but of how tight that relationship is. But I would say 9 out of 10 have had some pre-existing relationship, work together, etc.
Yeah. And of those 10 deals, how many were brokered by an investment banker?
I would say, and certainly, if investment banks play an important role in a process, and there's a few different ways that they can be really helpful. And one of in that 1 out of 10 where it's an acquirer that you didn't work with before, there probably was a banker involved in that one, right? So even though overall I would say it'd be less than half, in for companies and acquisitions that we would work on. The ones where it's someone you didn't know, that's probably the way that they came. I think bankers are helpful. If you already have some interest and you want to try to see if there are other people who are interested and kind of run an auction and have an intermediary who can sort of drive the price up. And that's not a crass thing to say. I mean, we've got a duty to your shareholders to do that, right? I mean, that's the fiduciary responsibility. That's often I think where bankers are they're the best in the world at doing that effectively and having a process to do that.
Yeah, I think that there's a lot of entrepreneurs that I've met that think, oh, if things go wrong, we'll just get acqui-hired, and they don't spend any time even building relationships with the big potential acqui-hires. They just think that acqui-hiring is kind of taken for granted. Acqui-hiring, as you've pointed out, it's even acqui-hires need these relationships in place before you go out looking for an acquisition. It's not It's not a thing that you can just take for granted in the startup world.
Totally true. Totally true. Everything that you said. The other thing is that timing matters a lot too, and these things take time. And if you think that at some point hey, if things don't go well, I can just flip the switch and sell the company, not only do you need those relationships, but you need time. And if, regardless of relationships, if acquirers sort of get the sense that there's desperation or you're running out of money or basically you don't have other good options, whether that's more funding or being profitable, etc., value that you've created as an entrepreneur can disappear very quickly because, there'd be a tendency to just, hey, well, if that's the case, we'll let these guys go out of business and then we'll try to hire them. So not always the case. Certainly acqui-hires happen, but to your point, it's usually where you've got a relationship and they know that the team is good, etc. The other thing I would say, back to the bankers, is that in a very relationship-driven acquisition, sometimes it can be, somewhat unhelpful, right? Is that if you're kind of establishing trust, let's say between you as the founder and, some, acquisition sponsor in the bigger company, to sort of interject another intermediary into that relationship isn't always the most effective thing to do. And that's, having some experience learning about it, having investors or board members who have some background in helping you through an acquisition process is a good thing too, because those are other proxies to kind of, see your way through that process if for some reason you actually didn't want to hire a banker.
So that makes a lot of sense. I mean, are there any elephant traps that you see entrepreneurs falling for the first time they go through the acquisition process?
I think the biggest one is that M&A is a fickle thing, and lots of things can throw a deal off from happening. So I always, when in a process, or not even a process, but let's say you get some interest. Hey, I was in a meeting with such and such partner, and they said, hey, we think that maybe we should just buy you instead. It's always, don't get distracted. Assume it's not going to happen until it's done, right? Until the whole way. And so keep focused on the business. Keep doing all the things you're doing. If strategically it makes sense to pursue that, there's a way you can do it in a way you can be respectful to who has that interest in you, but in a way that doesn't distract yourself, doesn't distract your team, because the thing that's most destructive is putting a bunch of eggs and get in a basket and getting distracted and then having it not happen and having to come back and pick up the pieces. It's really, really hard. But both emotionally, operationally, etc.
Going back to your venture capitalist hat for a minute, what do you look for in an entrepreneur?
Great question. Clearly look for somebody who's smart. At the very early stage where we're investing, you're generally we have a saying, and we're probably not unique with this saying, but you hope to be directionally right because you're almost certainly specifically wrong. And so, it's the art of, iterating to find that product market fit and then executing successfully against that. So obviously, you've got to have some intellectual horsepower to be able to do that. Have to be super high integrity, somebody that, we want to work with, that other people want to work with, who you would go into, quote, battle with and know each other, have each other's backs, and there can be a high degree of trust. Somebody who's got, strong, emotional IQ as well to be able to relate with people and relate to customers. I mentioned earlier, customer-centric, super, I won't repeat myself, but that's a super important part of it. And then I think the last thing, I could make a longer list, right? There's a whole bunch of attributes here that are important, but what I'd say is kind of the right balance of an aggressive, big vision. They're passionate about solving a problem and creating, in our case, creating a big company, creating something that can be, over $100 million a year in revenue. It can be a billion-dollar company. They're passionate about that and they think big about that, but they blend that with the right amount of pragmatism. They realize, look, we got to focus. First we got to crawl, and then we're going to walk, and then we're going to run, and can be very sort of systematic on what are the steps to actually get to that big vision. So if somebody's thinking too conservatively and too small, not a good fit for us. If somebody is sort of all vision and know, like, what do we actually have to do to focus to get there, that doesn't work well either.
That makes a ton of sense. What would you say is kind of the biggest pitfalls that you see entrepreneurs make?
Yeah, I mean, startups are hard, so there's a lot, right? Not just entrepreneurs; it's the ones that I've made, in trying to help entrepreneurs. But one of just to be redundant is like thinking you've sort of understood the customer and the requirements enough when really you haven't, so sort of doing and overdoing that customer development piece. Another one is, investing too much in sales and marketing, before you have that product market fit. It's probably the fastest way to, burn through cash, because you have to make sure you've sort of got a repeatable kind of fit with the product and with the market. There's pitfalls in hiring too fast and hiring too slow on both ways. I think that generally entrepreneurs are more afraid of, the market leaving them behind and having to move really quick, when in reality it's like getting it right is even more important and things end up taking longer. But again, if you don't have the right sense of urgency kind of across everything that you're doing, kind of in your urgency with getting it right, that balance again is super critical. And that, 2 or 3 of these things I just listed coming down to, don't run out of cash, right, and manage burn carefully, and don't get ahead of your skis and that side of things. And I think, this is a little bit of a blend of a pitfall, but also, something we look for in entrepreneurs is, you've got to be able to sell, right? I think a founder, a CEO is constantly also being a salesperson, not in a used car sales, kind of way, but you're either, talking to customers, you're talking to new employees, you're motivating existing employees, you're talking to investors, and being able to, sell the vision, sell the product, and motivate those constituents, is at the end of the day is critical. Lucas, I'm thinking through things that you did really well, and that's a big piece of it, right? Kind of blending this. You've got a vision for the technology and product and market, and then you got to sell all those different constituents on why that's right.
Yep.
You've had a lot of touch points, both as an early employee, as doing M&A, and now as a VC, both in terms of hearing pitches, making investments, but also as a board member. What's one of the most counterintuitive lessons you've learned personally along the way?
Yeah, that's a good question. I'm not sure if this is totally counterintuitive, but it's a little bit of a learning process I think you go through as an investor. I think it comes down to, when you're making a new investment decision, there's this, are you betting on the team, are you betting on the market, are you betting on the technology, and which is most important? Well, they're all important, at the end of the day, but I think people that have been investing for a while, they'll always say it comes down to the team, right? And the people you can work with and who can iterate and who can execute and sort of have that passion and that vision. Whereas I think, you might have the thought as you're kind of either a newer entrepreneur or a newer investor or a newer acquirer that it's like, look, I've got all these people, they want to join startups. Good people are all over, but the hard thing is the great idea with the great market, and to sort of, say, hey, that if you've got that, you can fill in with the right people. But the reality is, that's the challenge. If it's not your idea, or if you don't have that unifying person or people as founders who can drive the vision with their passion, it's difficult. So, it's the coming back around to realizing at the end of the day, it's the person and the people that you're investing in, and that's the most important thing.
So let's close on one last question. What is it about startups that attracts you the most? What do you like about startups? Why do you work with startups? What is it about it that brought you into startups?
Yeah, great question. I mean, I do feel incredibly lucky to be in this role. I feel like it's one of the most fun jobs you can have. Probably only second to actually being the entrepreneur, and the reason why is I just get fired up by new creative innovations that solve problems for people and for customers, and using technology to solve those problems. And maybe those solutions are making the world a better place, but you're definitely kind of curing pain points for folks. And I think that's really exciting. I love technology, and also from my seat, I get to see that in a whole bunch of different variety in different places every single day, and it's both the most exciting and the most frustrating part of the job. The excitement is being inspired by all these great people and ideas, and the frustration is always kind of being more like an inch deep and a mile wide, as opposed to going as deep as the entrepreneurs are on any one of these given problems and building their companies. But it's one of the things we bring to the table is that you as an entrepreneur are working on your company, and I'm working with 8 or 10 companies and seeing all these hundreds, and so I've got a better purview to see best practices, see what's working, what's not working, to kind of be your eyes and ears in the market, in addition to friend, consultant, psychologist, etc., and sort of helping however we can in small or big ways through the startup journey.
Awesome. Well, I really, really appreciate your time, and it's been great talking with you and learning from you, and it's been amazing learning from you for all these years that I've known you too.
I appreciate it, Lucas. It was great learning from you also, and it was a great ride, and I'm sure you or we are going to do it again at some point.
Absolutely.
Cool.
Thanks, Tim.
Thank you.
Thanks for listening to the Craftsman Founder Podcast with Lucas Carlson. If you like what you just heard, we hope you'll pass along our web address, craftsmanfounder.com, to your friends and colleagues. Be sure to check out our archive section on our website for previous podcasts. This has been a Craftsman Founder production. Join us next time for another edition of the Craftsman Founder Podcast.